Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the Australian Property Podcast. This is our weekly 2 cents segment. I'm Pete Wargent and I'm here with a very busy Chris Bates. Chris, how are you going?
Pete, life's good, mate. I do have to say this is one of my favourite times of the week, and I'm not just saying that. I really do enjoy our chats each week, and it's just a moment for us to really reflect on what's happened and what's changing, and what you're seeing and what I'm seeing, and all our networks and what they're seeing, and so and then to throw our 2 cents in really on what's happening in the market, and it's always stuff to talk about. I think we've been doing this for maybe 8 or 9 months now, and we're like, what should we talk about today? We've got 10 different options. So, things have been busy this week for me, Pete. 5 years in the making, 6 months working on it. We've done a huge merge with Christian Stevens, one of the big guys, I guess, in the industry. He won Australian Broker of the Year at one award. I won the other national award. We're combining to start a new brokerage that's sort of rebranding Blusk to now Flint. So we're going to do an episode with Owen straight after this one, which will come out in the next few days, and that'll give you a bit more details on why and what we're hoping to achieve. And I know that things have been busy on your end, Pete. We're just seeing a bit of a mixed bag, to be honest. I wouldn't say that there's this real FOMO in the market yet. And so that's really something that could come in the future. I wouldn't say it's in the market now. I would say there's definitely a appetite for people to buy. I don't think that because of borrowing capacity issues, savings issues, just the mortgage repayments and getting into the market's really hard right now, because you've got to have everything in your favor. You've got to have great incomes. You've got to have a lot of cash. So I don't think those buyers are there. And also I think the buyers in the market, they are a little bit picky. They're still not going, I'm going to buy anything on any street. Suburbs are quite patchy, I feel. And and investors are coming back, but they're nowhere near as sort of outrageous as a few years ago. So I would say it's been a surprisingly steady, but also, quite optimistic start. And a lot of buyers who've missed out over the last few years have been entering, have been buying. So, they've been maybe with us for 3 years, but haven't purchased. Or, been putting off an upgrade for 3 years and finally they're doing it. So what are you seeing up there in Brizzy and, other spots, Pete?
You stole the words right out of my mouth there. Patchy. Patchy was the word I was going to use. I've been chatting to a few agents this week. It's interesting. If you get an A-grade property, the open homes are packed and stuff is selling really quickly. But then there's other properties that for whatever reason, they just don't fly. And then they're not selling. We're very, very busy in Brisbane, a lot of interstate buyers and people relocating. But not every property's flying off the shelves. It's not FOMO everywhere. And definitely the same, actually, Sunshine Coast, I think prices have come off a bit. As you said, borrowing capacities are down. It's a little bit patchy. I've actually been in Dubai this week, so lots of construction over there and a lot of international travellers around. But back in Queensland this week, and it's busy. I think it's an interesting time for the property market. There's potential for things to really take off if interest rates start falling, but for the time being, there's some big results being achieved on some properties, and other stuff is sitting there not really achieving the same kind of results. So patchy, I think, is a good way to describe it. So
we've had a few clients recently who try to sell and haven't been able to sell. And so they're selling first because they want to upgrade and they do want to get out of the property. And the property, I would say, a few clients, they're not poor property. They're not like really busy roads and dark and run down and nothing going for them really. And, those properties are hard to sell unless the market's super hot for any decent price, unless you just want to take a bargain price. But these are decent assets, but they're highly priced for what they are really. And people are saying, well, if I'm going to be spending this type of amount, should I be a bit patient? And so I think that's a real litmus test to show that, the market is still strong, but it's not, going crazy. And that shows that, price growth is going to be really a flight to quality, really. This is what, downturns really teach, I think, people who watch property markets, is they show that, if you just analyze the property market over hot periods, you go, oh, wow, everything just goes up. You can't lose in property, blah, blah, blah. That sort of terminology starts to spin. I'll never be able to buy, etc. And then you go through these down periods and you see, wow, actually the people who were a bit more patient and took time to get better assets and were a bit more careful on what they bought, not just buying something, have a much smoother ride through these periods. And so, yeah, have you had any success buying, Pete? Have you? Because it's actually hard for you in this market, right? Because you can potentially buy stuff that's B, C's and D's, but the A stuff, you're like, bloody hell, there's 50 people at the open, and you're on your back foot.
Yeah, we've got a few over the line, but it's interesting. At a buyer's agency, there's periods when it's really easy to buy, but nobody wants to buy. And then there's periods where it's very difficult, and that's when everyone comes to you to solve their problem. So, yeah, we've got a lot of searches underway. Yeah, we've had some get across the line, but some have taken, multiple offers and multiple attempts to get stuff bought. I think because, as you said, stock levels are really low. And if you get something that ticks all of the boxes, even for units, there'll be 50 groups at the open home and it will sell above the price expectation or the price guidance from the agent. So, yeah, we have been getting stuff bought, but we've missed out on plenty as well. So, yeah, it's a bit frustrating and a bit bifurcated, I guess would be the way to describe it. So, let's have a look at the big three news stories of the week, shall we, Chris? So, firstly, a little piece on suburb-record prices, because we've seen a number of examples of that already in 2024. But I just want to do a bit of a drill into that, a bit of a deep dive, what it actually means. Because as we've touched on there, it's not like the whole market's going crazy or, there's definitely not the FOMO right across the market. So we'll take a look at that. Secondly, latest wages figures out this week from the ABS. Pretty interesting stuff going on there. And then thirdly, what have we got as a third news story of the week? Property investors returning to Sydney. So we had a bit of a hiatus there. And in fact, we actually had a very brief period where there were more first-time buyers in the market than investors, which is pretty unusual for New South Wales. But that's now reversed again. And the investors are coming back in, I guess, lured by record low rental vacancy rates and surging rent in some areas as well. So let's start with the story on suburb-record prices. So this isn't actually a news article, it's just an observation that I've been making. But also, if you follow Facebook groups like brisbanehomeprices.com, let me just run through a few sales from 2024. This is from Brisbane. Carina, 2.46 million, suburb-record. Chermside, 2.655 million, suburb-record. That's a big chunk of change for Chermside. Tarragindi, 3.75 million, suburb-record, and that wasn't even in the best pocket of Tarragindi. And then Carina Heights, 3,488,888, which I guess means an Oriental or Chinese buyer. I guess looking at those numbers, it's funny. Cameron Cusher was saying on Twitter, an extra $1 million for Carina Heights over Carina. It's all in the postcode name, as they say. But I think if you're not familiar with some of these areas, these are basically middle ring suburbs of Brisbane, where historically people have not been paying 2.5 to 3.5 million to live. Now, when you actually look at the types of properties that are getting those prices, they're generally new builds or major renovations, Hampton-style properties on, say, 5 to 6 or 700 square metre blocks. And I guess what this speaks to, Chris, is a few things. Very low stock levels and a very steep increase in building costs. I think those are the two factors here that are really driving. It's almost like squirting water through a hose. At the very top end of the market in those suburbs, prices like we've never seen before. Actually, thinking back to late last year, New Farm saw a sale at 20.5 million, which broke the previous record by more than 100%. So that was a big one. And actually, down your way, I think in Sydney, there was that place up on the cliff tops, Tamarama. I saw Lang Syne, the old bungalow there that sold for 45 million. I see that's now a pile of rubble. So that was basically just the land value. So yeah, it's interesting, isn't it? What are you seeing down your neck of the woods on the New South Wales coast? Are you seeing some top end boom prices, or is that more of a Brisbane thing?
I think there's absolutely in some suburbs you're seeing some, high end, top of the suburb prices. I mean, the good thing to track here is to go, well, is that actually the best suburb property in the suburb, right? And have a look at the address. Where is it located? Is it a massive block? Is it a north facing rear? It's in the best part of the suburb. It's got access to the public transport and the shops and the amenity, and, is it surrounded? Has it got a view? And I think that's when it gets really interesting. If you start to see, these prices and you go, hang on a sec, this doesn't seem that great, which is the sort of the Saturday night game that my wife sometimes hates that I play after the auction results come out at, 6 o'clock. I'm like having a quick squeeze. What's selling? And, and you go, well, that's a big price. And sometimes they, you go, well, that's fair enough. Great property, great frontage, great, you just ticks all the boxes. Sometimes you think, hang on a sec, like that seems a lot for that when you look at other sales in the suburb. And so I think with this sort of story, that's how I would really look at it, is going, if it's a suburb record and it's the best property in the suburb that's never transacted before, well, yeah, fair enough. But, if it's one of the poorer property, the middle properties, then you go, hang on a sec, if that's worth that, my property might be worth more. And that encourages more people to list, to be honest, because they go, hang on a sec, I didn't think that would sell for 2.6 million. I actually wouldn't mind selling my property. And so I have actually seen in past times where suburb records actually, come some retreat a little bit because someone's got an astronomical price and it can't be achieved by other properties even that are better than them. So, I mean, the Chinese buyer story, it could actually just be a Chinese seller, to be honest. Someone, we've had clients who aren't Chinese, let's say, and they've absolutely made offers with 888s in them because they think that might appeal for the seller. And so, yeah, I could flip that one in that direction as well. And but ultimately, I do think it's, not every part of the market. I mean, I'm just looking locally. There's been some big sales up here, some big prices that, arguably are almost what they would have sold at in 2021. And then I'm seeing other properties that, are B, C's and D's, and they're still well down on 2021, like I'm still talking 20% plus. And so, yeah, I think this is just, and that I think really is this inequality, sort of intergenerational wealth. I think this is going to play out for a long time. We're seeing, not just parents, not just grandparents. I can think of multiple clients in the last 3 months that brothers and sisters have helped out. And, they're potentially doing a bit better financially than their brother and sister. They can see that they're struggling. They can see they need to get into the market. Maybe there's some nieces and nephews there and they don't want them to move far away, and they think if they miss it now, and they're doing everything they can to help, and remortgaging and giving them money and loaning the money and investing, jointly with properties. And so I think that's, people who've got access to that are basically touching the whole family bank rather than just, mum and dad, which is really, creating these haves and have-nots, further accentuating that.
Oh, we've seen that too, definitely. I think it's the rental market that's driving it. I think a lot of parents are thinking, well, the rental market is really tough to find the place you want. Sometimes people are missing out, being outbid even on rental properties. And I think a lot of parents, and as you said, sometimes grandparents are saying, well, instead of stockpiling my wealth until an inheritance, when it's completely beyond my control what happens to the money you pass on, why not use some of it now to help my kids onto the ladder? It comes with a few sort of challenges financially in terms of how you structure it. How do you make sure that your different kids get the same kind of outcomes or similar outcomes? I think Stuart Weems at Pro Solution has done some good articles on this previously. And, how do you actually do this if you want to help your kids onto the property ladder? Do you buy jointly? Do you put it into, a family trust? There's all kinds of different permutations. But, yeah, we've definitely seen the same thing. You just gave us an amazing insight into your Saturday nights there, Chris. Gone are the days of cruising the bars of the eastern suburbs. Instead, checking on the auhouseprices.com to see the day's auction results. I'm sure your wife's thrilled by that Saturday night entertainment. But just a little quote from realestate.com.au. Dennis Nazar, director of Place Wollongabba, basically said that the newly built homes are selling at a premium price because of the time and cost to build or renovate properties. And he said, if people are looking to build or renovate, that just the cost and the length of time spent are much more now than they would have been previously. And in this market, it's easier to buy a new home and people are just looking to make their lives easier. So that does make a lot of sense, I think. If you think of the shortages we've seen on materials and trades and the way costs have gone for builds and developments, I think a lot of people would rather buy the finished turnkey product rather than try and do anything themselves.
Yeah, the appetite for, more larger, there's still people doing house and land, but, you can see the numbers are at all-time lows and new apartments and off the plan and things like that. And, I can think of a couple of clients who have come to us in the last 6 months who have bought off the plan and already before buying, coming to us. They can't get out of the contract. So there's no point, trying to discuss whether it was the right decision or not. They're in, right? And, a lot of that's way the contracts usually are, is it's very hard to on-sell prior to settlement. And one of these clients in particular I can think of, I don't know how they're going to settle. There's been some changes at work. The borrowing capacities have fallen. And, there's a servicing shortfall. We just don't have a solution right now. And we're not sure exactly how we're going to be able to settle this property. And, speaking to the developer and trying to get out of it and things like that, it's a sketchy situation. And so, yeah, that space in the clients coming to us wanting to do, $500, $700 million plus, $1.5, $2 million builds. We saw lots of that in 2020, 2021, like an enormous amount. Are we seeing much today? Absolutely not. It's A, because the cost of doing the build is much higher, but B, you got to say, do I really want to do that when I've got to pay 6% interest rates? That $1 million build cost me $60,000 a year to live in it. Whereas if I do it when rates are 2%, and it costs me $20,000 a year, it's only $1,500 extra a month on interest. We get all these lifestyle benefits. So I think people are like, well, yeah, I love a nicer home, but then I can't A, afford to do it, B, I don't want to pay all this interest. And so unless you're super cashed up and you're not going to use debt, then you don't really want to go and spend a lot of money on renovations right now. You want to sort of hunker down and wait till there's light at the end of the tunnel and rates start to fall, and then you have the confidence to start spending money on your place. So it's going to be interesting to see how it happens to building prices. There's you look at the longer term sort of stats on building prices, and there's very rarely a big dip in prices. And so, yeah, maybe the rate of growth slows down, but it doesn't sort of go negative dramatically. So it's going to be interesting to see how builders are able to hopefully hold their margins for their sake. And, because their margins are always quite thin, and they absolutely got smashed the last few years when the building prices ran on them and they were under fixed price contracts. And so, some people I feel for a lot of builders, to be honest. A lot of builders have gone under. They weren't, they were trying to just run a business on tight margins, and then that margin got absolutely wiped out and their business got wiped out. Years and years and years.
There's been plenty of that. Yeah, you're right. The build costs over time have actually increased above and beyond inflation over decades and decades, all the way back to as far back as we've got information, which is 60 odd years. And I think that part of that is an improvement in build costs, or build quality, I should say. I think what people want now is different to what they wanted a few decades ago. Yes, I suppose, you could question that with some of the new apartments, but I think, people are looking, as you said, they want more space these days. There's it's not really a like-for-like comparison, but it's a bit like with fuel prices. The costs seem to go up, but they're very sticky and they don't come back down. Interesting, you mentioned there, some people finding difficulty settling. There was some information out from Westpac this week in their latest quarterly figures, and it's clear that stressed exposures are finally rising now. I mean, that's not a big surprise, right? We've seen this brutal increase in interest rates very quickly. But it's just now starting to flow through. I think we're probably 80% of the way through the fixed rate cliff now. But if you get a rate hike, it's not a one-time event. Those mortgage repayments are recurring every month, and the stress is building cumulatively. Unemployment just starting to inch up as well. So, I think it's the general vibe seems to be interest rates will be on hold for the next 6 months. But the stress is just beginning to flow through now. So it'd be interesting to see how all of that plays out as the year goes on. So we've got a bit more info. Second news story this week. ABS released the latest wages figures, which I think are being watched quite closely by the central bank, just to, I guess the feeling used to be that we get this, the wage price spiral, if wages were too hot. So wages growth came in slightly stronger than expected, 0.95% if you want to put 2 decimal places on it for the December quarter. If you think back to the previous result, we had the big minimum wages boost this year, which kind of pumped up the figures. So over 2023, wages were up 4.2%. If you look around the traps, Queensland 4.8% was top of the tree, and WA now is having a bit of a boom, 4.7%. Slowest wages growth was in Victoria for various reasons, 3.7. So if you look, most states and territories are getting wages growth of about 4.3%, I guess, last year. I think the quarterly result was a bit better than expected because of the pay rise for teachers that flowed through in Q4. Over the year, healthcare, biggest wages growth, 5.5%. And actually, just an interesting thing, the public sector wages growth at 4.3%, a bit stronger than private sector. I think if you go back all the way back to the start of this data series, which is 1997, you've actually got public sector wages have gone up a bit more than private sector, 133% versus 120. So I think we had some really strong wages growth in Australia through the mining boom years. But then since then, we've just had really high immigration and a slower economy. And I guess wages growth has been fairly lackluster, really, for about a dozen years in Australia. So getting above 4% is good to see. And now actually ahead of the rate of inflation, which is something we haven't been able to say for quite a while.
Yeah, and I think that's kind of the key point here, right? The cost of living crisis is really hard when you know your costs are going up higher than what you're getting wage increases, and that money's got to come from somewhere. And I think it's been particularly bad in some other countries around the world. You think about the UK. I think that cost of living crisis is way worse. The inflation rate's got much higher, and the wages didn't increase as much. What's your sort of take on what happened in the US and UK around this story, Pete?
Yeah, it's definitely different setup. So I think just generally the story in the US, a lot more demand driven, their economy, the boom. And I think the interest rate hikes just haven't had the same effect in some other countries, largely because most people in the housing market are on fixed rate mortgages. So yes, you can see what's happening to the cost of money, but it doesn't impact people as quickly. Whereas in Australia, most of us are on variable rate mortgages, so you get a rate hike and bang, it's flowing through to your bank account really quickly. And even with the fixed rate surge of people taking out those products, well, they're generally only 1 or 2 year fixed rate mortgages, sometimes 3. So even if the rate hikes don't impact those people immediately, you can see it's coming down the track pretty quickly. So yeah, I think wages growth has been stronger in other countries. The history of this data series for wage prices in Australia always seems to disappoint. And but I think in particular, just the last dozen years, we've seen very, very high rates of immigration in Australia. Like we saw that through the mining boom, the early 2000s through to 2007, 8, 9, around that period, which kind of made sense because we had the mining boom. But then we just somehow got addicted to very high rates of immigration. Even when the economy didn't really justify it. I guess we were backfilling a lot of high-rise apartments there through around sort of a decade ago or so. And I think that's just really depressed wages growth, certainly as compared to, say, the US or the UK, where wages growth has been sky high in nominal terms anyway. So, yeah, I think it's, I would say this is really a strength rather than a weakness for Australia's policy. Interest rates, you can dial them up and down and have an impact much more swiftly. And it's far more effective, I guess. So if you need to cut interest rates to get things moving, or if you need to hike them to slow things down, the impact is much sooner than you might see in, say, the US. And
what's your sort of take on, there's this idea that, that inflation inflates debt away, right? And wage growth is kind of making debt more affordable, right? Because we've got higher wages means we can take on more debt. If interest rates stay the same, then we can take on more debt. So, could this be the bit of a Goldilocks situation? I'm not saying we've got this soft landing that we came into COVID, we dropped rates, massive increase in prices of assets. Gross price of assets have gone up. Maybe debt hasn't gone up for a lot of people, right, because they didn't transact. But now ultimately their wages have gone up. And, if rates start to fall again, have we just inflated some of our debt away? Particularly if our rates start to fall dramatically and, the inflation story, has got put back in the bag. What's your sort of take of that? If we fast forward a few years' time, have people, that $1 million mortgage isn't going to be $1 million mortgage like it was, say, in 2020, in 2027, right? If wages have gone up a lot and you've kept your $1 million mortgage, well, that's much more affordable when wages are higher, particularly because wage growth isn't even. If we lived in an economy where everyone got paid the same wage growth, then yeah, absolutely. But unfortunately not the reality, right? And some markets' wage growth as a suburb is much higher because not only the people in the suburb getting, higher wage growth because of the industries they work in and then their stage of life and their careers, but also wage growth is actually the transition of people within a suburb. This is what a lot of people mix up when they think about income growth in a suburb. They forget that, income growth might not be that big at a suburb level, but the buyers in the suburb could be much higher incomes today than they were 2 or 3 years ago. And there's this changing of a guard. It's kind of the ripple effect. Medium incomes were buying there, but then unfortunately the higher incomes got pushed out a couple of suburbs in, and then they're pushed onto the suburbs. So the whole buyer pool is changing, and income growth at a whole suburb level is changing very little because only 5% of properties are transacting. But those 5% of people coming to are way higher than they were a few years ago. And that's something to really look at. So what's your sort of take on this debt inflation? The governments don't mind having big debts as long as it's on low interest rates and GDP is growing.
Yeah, so I guess that's the general theory of investing in real estate is that it's effectively an inflation hedge. So if you were to take out, for the sake of argument, a 500k mortgage today that's over 25 or 30 years, even if you didn't pay off a single cent of the mortgage, you're on a very long sort of interest-only term for the sake of argument, it would feel like debt of about 200 or 250 by the time you got to the end of that mortgage term. And of course, as most people pay down their mortgage over time. I think yes, I mean the nominal wages growth has been quite weak actually in Australia since the peak of the mining boom, and only now we're starting to see it pick up again. So I think you're right. I mean, if you look at inflation cumulatively since 2020, and more so in some other countries actually, you're probably looking at maybe 30% increase in the cost of living. For things like build costs, it's been more like 50, and that's over a relatively short period of time. And I guess that's how it works with real estate as an inflation hedge, is that, if you get 2 or 3% inflation, it doesn't sound like a lot, but if you're sort of compounding that out over 10, 20, 30 years, it does have a big impact. I think another thing as well is that what tends to happen is that the wage price index might show 3 or 4% growth, but for most of us anyway, as we progress through our careers, we'll go from, well, I'll take my own journey as an example. I started out as a graduate training to be a chartered accountant. I think my first salary would have been, gosh, it's a few years ago now, but for the sake of argument, about 35k or something like that in Aussie dollar terms. And then you sort of go up the ranks, then you become like a senior analyst, and it might be a bit more. And once you qualify as a chartered accountant, you're probably earning about double. And then you've got managers and senior managers, directors, partners, and so on. So even though the wage price index might be doing one thing, your personal income earning potential tends to improve over time. I think the other thing, as you touched on there, is that in some suburbs that are gentrifying, or if you're getting that ripple effect of prices, then the demographics change within a suburb. There's some really good examples in Brisbane, like the Inner West, Indooroopilly, and people get priced out, so they go further along the train line, and they go out through Graceville and Sherwood and Corinda, and now they're buying in Oxley, and eventually people get priced out of there and they move further along. So the demographics within suburbs change, and people's incomes tend to increase as they go through their careers as well.
Yeah, and it absolutely can slow down. Someone's career, they could buy a property and they were on their peak salary, right? And they bought a house in X suburb and then they lived there for 30 years. And right, so their wage may have been peak and maybe it's gone down because they've started to, dial their hours down and got into retirement. But, if that person that's in the 60s, 70s, 80s downsizes and then they leave the suburb, or someone dies and someone else moves into the suburb, then the wage growth can really start to change on the buyers in that suburb. And so I think that's a really thing people to really try to consider more and more how a suburb's shifting and who's the buyers and who's ultimately what are they earning and what cash have they got access to, and because that's what drives prices, is the buyers in the market today and ultimately what the buyers will be in the market in the future. And the more money they have and the more money they earn ultimately will mean that they've got high borrowing capacities and more money to spend. And so you've got to always be thinking about the buyer today, the future buyer, and what's their financial setup to drive prices.
I saw some debate on social media this week about why do we even need to have inflation? Why can't we just have the cost of living staying flat? I guess that's a long form discussion, but generally the idea is that with a fairly sort of well anchored rate of inflation, people will be encouraged to spend and invest rather than stockpile their cash. And what we want to avoid, I suppose, is deflation, where people feel like putting off their expenditure into the distant future because things are getting cheaper. So that's the economic theory. And I guess if you went back to the 1930s, for example, there's periods where we had deflation and it wasn't good. We get into this liquidity trap. So, yeah, I mean, it's a big discussion that, but this is the system and you've got to work with it. Inflation might not sound a lot, we had 7% in Australia, but if you project it out over the years, like you look back at what stuff cost 10, 20, 30 years ago, the cumulative impact is enormous. And I guess that's why well-located real estate has tended to act so well as an inflation hedge. The demand for land goes up and the cost of building never seems to come down. And over time, prices go up. Now, in that context, Chris, third and final story of the week, property investors returning to Sydney. And it was reported in Domain's latest house price report that Sydney's median house price hit an all-time high of nearly 1.6 million at the end of 2023. So, I mean, it's quite a good example. If you think back as far back as we've got reliable figures to about 50 years ago, the price of a house was under 20,000 in Sydney and now it's 1.6 million. That's the cumulative impact. So what's happening? Rents are rising and investors are coming back. I think Domain showed relatively little year-on-year price growth for Melbourne, Canberra and Hobart. So maybe Melbourne might be the contrarian play now with Sydney getting expensive again. Just interesting to see. Macro Business, Leith Van Onselen did a piece showing how investor loans are now 40% of the market in New South Wales again. There was a little period during COVID where there were more first-time buyers in the market than investors, which is really unusual for New South Wales. But that's now gone away again. The investors are coming in, so we'll have that tension, I guess, again, where investors are competing for similar stock as first-time buyers. And I think what's happened is that investors were out of the market for quite a while, but now we've got record low vacancy rates. Rents are up 15, 20% over the year, and it's just bringing people back in. Probably a sense that we're close to the peak of the interest rate cycle as well.
Yeah, I think that's absolutely what's happening. Is the investors are usually people. I think a lot of these investors are first-time investors as well, first-time buyers that can't afford to buy something to live in or in an area they want to be, and so they're just buying an investment property. So yeah, I think it could be some of the investors that have come into the market are actually first home buyers. We absolutely are seeing people who are in homes that they want to live in long term. They've got a buffer. They're on top of their mortgage. They don't need to do any major renovations to it. They, have got a long runway there. They ultimately, this is their forever home, and they've sort of said, well, we potentially might want to live in some property long term in the future, but we absolutely love where we want to be, and we've got heaps of equity, and we've actually got a decent borrowing capacity right now, and that's unlikely to change much in the future because their incomes are sort of at certain levels. So you're talking more of the maybe early 40s to mid 40s type of person, and they're going, well, I've still got a long runway to retirement. I need to do something for my future. I have just focused on paying my mortgage down and doing some renos. I am putting a bit into super, but I know I can't put in a ridiculous amount in there over the next 20 years. And so, do I use my borrowing capacity now, or do I, potentially just buy some shares, or what do I do? And I think that's where I think these investor numbers are getting driven by that type of person who is also saying, hang on a sec, my kids are maybe 10 or they're 6 or they're 12, and they're going, hang on a sec, how are they actually going to be able to rent something in 10 years' time? Maybe I should buy an investment now that they can sell one day. That is a lot of the motivation I find with investors, is that they're doing it, yes, for themselves, but what actually motivates them to take action for themselves is seeing the future pain for their kids. And they sometimes people say, I want to buy a property for each kid or something like that. I sort of try to reframe it and say, build family wealth that you can then help kids. Like, don't buy assets for them, just build your own asset base, and then you can make a decision on how you help and when you help and what you do, depending on how their life plan plays out. You might not want to give them the money or give them the property if they enter a relationship that, then they get a de facto issue or whatever it might be. You want to be able to hand it out when you want to handle that at the right time. It's actually going to help them the most. You might help them money to start a business. Sometimes just allocating properties to kids, I don't know if that's the best option, but just buying properties and assets for them and getting them to grow over the longer term is a good strategy. And so, I do like seeing the first home buyer do really well. I do like to see that number, like it did in 2021, overtake investors. But when you look out over the longer term, the investors have absolutely smashed first home buyers entering the market. In these numbers are all showing, circa 35-40% of lending in sort of Sydney, and first home buyers are like 15-20% of the market. So it seems like we're going back to sort of those longer term averages. That's actually good news for the rental market. Maybe not great for the first home buyers, but the other side of the investor story is there's still a lot of investors bailing. A lot of the properties on the market where there are listings, and there's, where they're in the apartment markets are owned way more than 30% by investors. It's, they're more like 50, 60, 70, 80%, right? And so, while more investors are entering and more likely buying apartments due to affordability, there are also a lot of investors bailing. And I think that's one of the issues that I would say in the rental market is I don't see that end in sight, that there's going to be lots and lots of choice for renters.
Definitely. Actually, some of the properties that we're getting off market or pre-market are properties that are tenanted, and there were properties that were bought maybe 2021, 22, where people were buying on very low fixed rate mortgages, and now they're looking at it with 6% mortgage rates breathing down their neck, and they're like, you know what, I'm going to cash in here. So we've seen plenty of that actually, and yeah, you're right. Some of those trends I think are just ongoing now. The parents helping their kids, we're seeing so much of that at the moment. Just they've got sort of retirement wealth, but they're thinking, well, maybe I should pass it on now rather than later. Just help the kids onto the ladder. Seeing that all over the place, New South Wales, Queensland. So I think it's probably going to be an ongoing trend. I think there was this thing about 10 or 12 years ago where people were saying the first home buyers have been knocked out of the market. But when the ABS actually analysed it, a lot of the investors were actually first-time buyers, but they were buying an investment property as their first property onto the market. The number of first-time buyers hadn't changed that much, and I guess we'll see a bit of that now too. As you said, some people will rent and buy an investment property as their first foothold onto the ladder, and that can make sense for various people. I think in Sydney, there's often been this thing where people who are Sydney-siders, they just don't look into states at the more affordable markets. They just think Sydney is the place, and I'm just going to buy in Sydney. But yeah, looking at some of those year-on-year prices, there's probably some other markets that will get some attention, not least Melbourne, I guess, with the prices not having rebounded to anything like the same extent as Sydney. So, Chris, we're almost running over time here. You've gone through a big change and a rebrand this week. Now, where can people go to catch you these days? I know you've gone through a rebrand.
Absolutely. Blust is still running for the next few weeks. Blust.au, but more importantly, the best way to get in contact with us is through the type form in the show notes. Team would absolutely love to help. And Pete, you got any more capacity at the moment? I know you've got a lot of buyers out there. How's the team? And you can handle a few more clients up in Brizzy or Newcastle where you're buying?
Yeah, we certainly can. Yeah, the team's been very busy, but we're getting a few bought now. I guess listings are starting to pick up third week of February, so we're actually getting a bit more choice. So yeah, Alan Wargent, property buyers, alanwargent.com.au, drop us a line. Always happy to have a chat. So yeah, just to wrap up on this week, suburb record prices in some parts of Middle Ring Brisbane, but the market overall, I would say, is much patchier than some of the media might have you believe. Wages trends, 4.2% wages growth in 2023, but we'll probably see that slow to closer to 3% this year with immigration picking up and property investors coming back into the Sydney market, pushing prices up again. It's like a story that goes round on a loop, that one. So, Chris, brilliant to chat as always. I'll look forward to catching up around the traps at some point and enjoy the rest of your weekend.
Thanks, Pete. Happy Sunday, everyone. Chat next week.
Cheers.